Now, my first guest today is the CEO and Chief Investment Officer of U.S. Global Investors, and he's been talking about how investors should put at least some of their capital into gold. Let's find out if at $954 an ounce, whether buying gold now makes sense. Let's introduce Frank Holmes, comes to us from San Antonio, Texas. Frank Holmes, welcome.
It's great to be back.
Frank Holmes, at $954, is gold a buy for investors?
Well, I think if gold is due for a correction, which we're getting today, it was off over $25 because the dollar rallied substantially. And what we've noticed in our models is that gold in a short period of time is overbought and the dollar is oversold. And you usually get this thing called mean reversion. They come back to an average. But I think investors should always have a little exposure to gold. And I think it's 5 to 10% weighting is prudent, and to rebalance that once a year.
Why do people need to be invested in gold? It doesn't pay a dividend. Are you concerned about the devaluation of the U.S. dollar, of fiat currency?
Well, that's a real concern. I just traveled all around the world, and it's a very much a concern of the debasement of all currencies, and particularly what's going to have to take place with the dollar. I think what happens, Pam, is what I've noticed is that whenever we have negative interest rates, that is, what you earn in a money market fund after inflation, and it is negative, then gold becomes an extremely attractive asset class. And what I've also noted in the past 9 years is we're dealing with a great deflationary cycle, and gold has gone from $250 to $1,000 in a deflationary environment. And why is that? Because 80% of the time we've had negative interest rates to keep the economy going.
So what about the inflation scare? Are you concerned at all that government quantitative easing, as well as the purchase of various types of, let's say, non-treasury debt by the Federal Reserve, do you feel that that is going to fuel inflation?
I believe that it'll be modest. I think the real concern we have is protectionism and unionism. History has shown that whenever you have protectionism and unionism, that you get a run of everyone trying to front run each other on raising their income to pay for life. And that's what happened in the 70s. Unions dominated and caused a lot of difficulty, and everyone was raising their prices. We don't have that right now.
So you're saying that there's no wage pressure in the economy?
Correct. There's no, except for legal bills. That's the only thing I complain about. They have a monopoly.
All right, so increased legal bills. But having said that, in your travels, are people worried about the falling value of the U.S. dollar? Because it seems as though we hear a lot of investors talking about the risk trade, de-risking. Wouldn't that be bad for gold as well as for the U.S. dollar?
Well, the concern is that if they're going to have deficit spending, what will the money be directed towards? Will it be just welfare checks giving out to people, or will it create something that's sustainable job creation? And the policies. The concern is taxes rising too early could cause a rebound in this economy, so we have to turn up and they could turn down again. These are the concerns I've heard around the world. This going after tax havens and accusing everyone in islands, etc., that it's a tax haven is false. And it's generalist thinking. And so that is a concern that Singaporeans have, Bermudians have, and we're seeing this also in other places around the world.
So where should investors be putting any new money if they want to add to their portfolio?
Well, one big important part is that people should be looking at this market as governments around the world are committed to building their economies. And it's very important, and we're seeing for the first time, compared to the 70s, when China and India, which is 40% of the world's population, that there are policies there for job creation, sustainable job creation. And that's what I believe is very, very important, and it's why Asia and emerging markets were first to rebound this year.